Hello everyone, I am Varnika from Bachelor's of Management Studies, Keshav Maha Vidyalaya, University of Delhi. And in this presentation for financial institutions and market, I'll be presenting the topic for private equity. Private equity typically refers to investment funds generally organized as limited partnerships that buy and restructure companies that are not publicly traded. Private equity is composed of funds and investors that directly invest in private companies or that engage in buyouts of public companies, resulting in the delisting of public equity. Institutional and retail investors provide the capital for private equity, and the capital can be utilized to fund new technologies, make acquisitions, expand working capital, and to bolster and solidify a balance sheet. A private equity has limited partners who typically own 99% of shares in a fund and have limited liability, and general partners who own 1% of shares and have full liability. The latter are also responsible for executing and operating the investments. Advantages of private equity. Private equity offers several advantages to companies and startups. It is favored by companies because it allows them access to liquidity as an alternative to conventional financial mechanisms such as high-interest bank loans or listing on public markets. Certain forms of private equity, such as venture capital, also finance ideas in early-stage companies. In the case of companies that are delisted, private equity financing can help such companies attempt unorthodox growth strategies away from the glare of public markets. On the other hand, private equity also faces some unique challenges. First, it can be difficult to liquidate holdings in private equity because, unlike public markets, a ready-made order book that matches buyers with sellers is not available. A firm has to undertake a search for a buyer in order to make a sale of its investment or company. Second, pricing of shares for a company in private equity is determined through negotiations between buyers and sellers and not by market forces, as is generally the case for publicly listed companies. Third, the right of private equity shareholders are generally decided on a case-by-case basis through negotiations instead of a broad governance framework that typically dictates right for their counterparts in public markets. Private equity firms raise money from institutional investors and accredited investors for funds that invest in different types of assets. The most popular types of private equity funding strategies are listed below. We shall look into each one of them in details. Leveraged buyouts. This is the most popular form of private equity funding and involves buying out a company completely with the intention of improving its business and financial health and reselling it for a profit to an interested party or conducting an IPO. The companies involved in these transactions are typically mature and generate operating cash flows. Leveraged buyouts involve a financial sponsor agreeing to an acquisition without itself committing to all the capital required for the acquisition. Therefore, in LBO's transactions, financial structure is particularly attractive to a fund's limited partners, allowing them the benefit of leverage but greatly limiting the degree of recourse of that leverage. This kind of financing structure leverage benefit an LBO's financial sponsors in two ways. First, the investor itself only needs to provide a fraction of the capital for the acquisition, and second, the return to the investor will be enhanced as long as the return on asset exceeds the cost of the debt. The working of leveraged buyout can be seen in the diagram. Here, a private equity firm identifies a potential target and creates a special purpose vehicle for funding the takeover. Typically, firms use a combination of debt and equity to finance the transaction. Debt financing may account for as much as 90% of the overall funds and is transferred to the acquired company's balance sheet for tax benefits. Private equity firms employ a variety of strategies from slashing employee count to replacing entire management team to turn around a company. Venture capital. Venture capital funding is a form of private equity in which investors, also known as angels, provide capital to entrepreneurs. Venture capital is a broad subcategory of private equity that refers to equity investments made typically in less mature companies for the launch of a seed or startup company, early stage development, or expansion of a business. Venture investment is most often found in the application of new technology, new marketing concepts, and new products that do not have a proven track record or stable revenue streams. Venture capital is often subdivided by the stage of development of the company, ranging from early stage capital used for the launch of startup companies to late stage and growth capital that is often used to fund expansion of existing business that are generating revenue but may not yet be profitable or generating cash flow to fund future growth. Venture capital is more suitable for businesses with large upfront capital requirement which cannot be financed by cheaper alternatives such as debt. Growth capital. Growth capital is a type of private equity investment, usually a minority investment, in relatively mature companies that are looking for capital to expand or restructure operations, enter new markets, or finance a significant acquisition without a change of control of the business. Companies that seek growth capital will often do so to finance a transformational event in their life cycle. These companies are likely to be more mature than venture capital funded companies, able to generate revenue and profits but unable to generate sufficient cash to fund major expansions, acquisitions, or other investments. Because of this lack of scale, these companies generally can find few alternative conduits to secure capital for growth, so access to growth equity can be critical to pursue necessary facility expansions, sales and marketing initiatives, equipment purchases, and new product development. Distressed investment. Distressed or special situation is a broad category referring to investments in equity or debt securities of financially stressed companies. The distressed category encompasses two broad sub-strategies including distress to control or loan to own strategies where the investors acquire debt securities in the hopes of emerging from a corporate restructuring in control of the company's equity. Second, special situations or turnaround strategies where an investor will provide debt and equity investments, often rescue financing, to companies undergoing operational or financial challenges. Mezzanine capital. Mezzanine capital refers to subordinated debt or preferred equity securities that often represent the most junior portion of a company's capital structure that is senior to company's common equity. This form of financing is often used by private equity investors to reduce the amount of equity capital required to finance a leveraged buyout or major expansion. Mezzanine capital, which is often used by smaller companies that are unable to access the high yield market, allows such companies to borrow additional capital beyond the levels that traditional lenders are willing to provide. In compensation for the increased risk, mezzanine debt holders require a higher return for their investments. Mezzanine securities are often structured with a current income coupon. Secondary investments. Secondary investments refers to the investments made in existing private equity assets. These transactions can involve the sale of private equity fund interests or portfolios of direct investment in privately held companies through the purchase of these investments from existing institutional investors. By its nature, the private equity asset class is illiquid, intended to be a long-term investment for buy and hold investors. Some other private equity strategies involve real estate. Private equity real estate involves pooling together investor capital to invest in ownership of various real estate properties. Merchant banking. Negotiated private equity investment by financial institutions in the unregistered securities of either privately or publicly held companies. Royalty fund. An investment that purchases a consistent revenue stream deriving from the payment of royalties. Fund of funds. Investments made in a fund whose primary activity is investing in other private equity funds. The fund of funds model is used by investors looking for diversification but have insufficient capital to diversify their portfolios by themselves. Access to top performing funds that are otherwise oversubscribed. Experience in a particular fund type or strategy before investing directly in funds in that niche. Exposure to difficult to reach and or emerging markets. Superior fund selection by high talent fund or fund managers or teams. Now let us take a look at the history and development of private equity. While private equity has garnered mainstream spotlight only in the last 3 decades, tactics used in the industry have been on since the beginning of last century. The seeds of the US private equity industry were planted in 1946 with the founding of 2 venture capital firms, American Research and Development Corporation and J.S. Whitney and Company. Banking magnate J.P. Morgan is said to have conducted the first leveraged buyout of Carnegie Steel Corporation, then among the largest producer of steel in the country. Modern era private equity, however, is credited to Georges Deroit, the father of venture capitalism, with the founding of ARTC and founder of INSEAD. How do private equity firms make money? The primary source of revenue for private equity firm is management fees. The fee structure for private equity firms typically varies but usually includes a management fee and a performance fee. Certain firms charge a 2% management fee annually on managed assets and require 20% of the profits gained from the sale of a company. How private equity creates value for a company. Deal origination involves creating, maintaining, and developing relationships with mergers and acquisitions, intermediaries, investment banks, and similar transaction professionals to secure both high quantity and high quality deal flow. Transaction execution. This involves assessing management, the industry, historical financials and forecasts, and conducting valuation analysis. Functions of private equity. Shareholder profits. The primary function of private equity, as with any other business, is to create a profit for its investors. Private equity firms accomplish this by purchasing smaller companies, increasing their values, and selling them at a profit. Industry expertise. In an effort to improve the company's performance, private equity managers will bring in operating partners with expertise in that company's industry. Equipment improvements. The costs involved in upgrading equipment can stop a business from expanding to its fullest potential. Another facet that private equity brings to a small business is the capital infusion needed to replace and upgrade outdated equipment. Access to new markets. With the expertise and expanded production capabilities that private equity provides, companies can gain access to markets that may have been closed to them when they operated on a smaller scale. Return on private equity investments. Returns on private equity investments are created through one or a combination of 3 factors that include: first, debt repayment or cash accumulation through cash flows from operation; second, operational improvements that increase earning over the life of the investment and multiple expansions; third, selling the business for a higher multiple of earnings than was originally paid. Lastly, let's compare private equity with hedge funds. The investment strategies of private equity firms differ to those of hedge funds. Typically, private equity investment groups are geared towards long-hold, multiple-year investment strategies in illiquid assets, where they have more control and influence over operations or asset management to influence their long-term returns. Hedge funds usually focus on short or medium term liquid securities which are more quickly convertible to cash, and they do not have direct control over the business or assets in which they are investing. Both private equity firms and hedge funds often specialize in specific type of investments and transaction. Private equity specialization is usually specific industry sector asset management, while hedge fund specialization is in industry sector risk capital management. Private equity strategies can include wholesale purchase of a privately held company or set of assets, mezzanine financing for startup projects, growth capital investments in existing businesses, or leveraged buyout of a publicly held asset converting it into private control. Finally, equity firms only take long term positions. For short selling, it is not possible in this. Thank you.